In 2025, the global markets present a mix of promise and uncertainty. High inflation, rapid technological advancements, and the growing demand for sustainable energy create exciting opportunities, but also make it harder to separate winners from underperformers. How do you grow your portfolio without taking on unnecessary risks? In this video, I'll show you the top 6 high-growth ETFs ready for success, explaining their unique advantages and why they deserve a place in your portfolio. In the end, I'll reveal a high-growth ETF that can potentially turn your $10,000 investment into a 7-figure portfolio valuation, paying over $50,000 in annual dividends. First, let's start with what ETFs are and why ETFs are such a big deal for 2025. ETFs offer a mix of investments wrapped up in one neat package. They're not just easy on your wallet because of their lower fees, but they're also super convenient for diversification. Instead of betting all your money on one stock, you're spreading it out, which makes your investment game much safer. And the cherry on top, ETFs let you jump into trending industries like clean energy or smart tech without needing a PhD in finance. I've arranged the top performing ETFs for 2025 in descending order, starting from number 6 and working up to the best, ranked by each ETF's potential to add value to your portfolio. Starting at number 6, I have the Schwab U.S. Dividend Equity ETF with the ticker symbol SCHD. This ETF is a standout choice for investors looking for a blend of stability, growth, and income. Unlike high-risk leveraged ETFs, SCHD is all about steady, reliable performance, making it a go-to option for long-term investors. This ETF tracks the Dow Jones U.S. Dividend 100 Index, which focuses on 100 high dividend-paying U.S. companies with strong financials. These are not speculative bets, but well-established businesses with proven track records of profitability and sustainability. SCHD offers several appealing features, starting with its attractive dividend yield of around 3.39%, providing a steady income stream. More importantly, it focuses on companies that consistently grow their dividends, offering potential for increasing income over time. With a low expense ratio of just 0.06%, SCHD ensures cost-effective exposure to quality dividend stocks. Additionally, it provides broad diversification across sectors like technology, consumer goods, and financials, reducing the risk of over-concentration in any single industry. Its dividend yield is backed by a growth rate of 11.13%, and it also has an average share price appreciation of 7.95%. Starting with a $10,000 investment, after 1 year, the portfolio grows to $11,134, reflecting steady initial returns. Over 10 years, the value increases to $30,695, tripling the original amount. By year 20, the investment reaches $107,070. Fast forward to 30 years, and the portfolio value climbs to $443,711, an impressive 43-fold increase from the starting investment. SCHD also delivers meaningful income. By year 30, annual dividends rise to $32,047, or about $2,671 per month, providing a reliable income stream. Of the $433,711 total value added, $230,995 comes from capital growth, and $202,715 is generated by reinvested dividends. Next up at number 5 is Invesco S&P 500 GARP ETF with the ticker symbol SPGP, or you could say growth at a reasonable price. This ETF is about finding stocks that are growing but aren't crazy overpriced. It picks companies from the S&P 500 that are not only growing their earnings, but also aren't priced like a collector's item. Why is this important for 2025? Well, the market's been a bit of a roller coaster lately, and investors are leaning toward companies that aren't just hype. This ETF is packed with businesses that have solid fundamentals, companies with strong earnings growth and reasonable valuations. It's the ultimate mix of stability and upside potential. Now, imagine a tech company that's innovating like crazy but still has its finances in check. Or a healthcare giant rolling out life-saving treatments without breaking the bank. These are the kinds of gems this ETF hunts down. This ETF isn't sector-heavy, too. You're not putting all your eggs in the tech or healthcare basket. Instead, you're getting a diversified portfolio that can weather economic ups and downs. So whether the market is feeling bullish or bearish, you're still in a solid position. So let's break this one down. SPGP has a current dividend yield of 1.31%, backed by strong dividend growth of 11.27% and share price appreciation of 12.89%. Starting with an initial investment of $10,000, the SPGP ETF offers a balanced mix of growth and dividends. After the first year, you'll be looking at $11,420. Fast forward to the 10-year mark and the portfolio value climbs to $37,427. In 20 years, your portfolio would be worth $137,837. At 30 years, the compounding effect really kicks in. With reinvested dividends, the portfolio reaches $500,730, paying an annual dividend of $3,592. The total value added to your portfolio will be $490,730, with $458,254 coming from capital appreciation and $32,476 from reinvested dividends. Next, at number 4 on our list, is First Trust's NASDAQ Clean Edge Smart Grid Infrastructure Index Fund ETF, or GRID for short. This ETF focuses on companies that are revolutionizing how we generate, store, and use energy. Think smart grids, renewable energy, and electrification. Let's face it, the world's not getting any less dependent on electricity. From your smartphone to electric cars to AI-powered homes, we're all plugged in, and that's not changing anytime soon. And in 2025, as countries double down on sustainability goals and green energy policies, GRID is in a prime position to benefit from it. As for the numbers, clean energy isn't just ethical, it's profitable. Governments and corporations worldwide are pouring billions into clean energy initiatives, creating a massive market for companies in this space. With a current dividend yield of 1.08%, this ETF offers strong fundamentals, including dividend growth of 8.98% and a 13.33% increase in share price appreciation. With a $10,000 investment in this ETF, yours and John's $10,000 investment would be worth $11,441 by year 1. In 10 years, capital appreciation from the clean energy sector boosts the portfolio to $37,798. After 20 years, your investment would be worth $138,918. Over 30 years, it has the potential to reach an impressive $501,439. Your portfolio will see a total value increase of $491,439, comprising $476,534 from capital appreciation and $14,904 from reinvested dividends. Now, for some, this might not be sufficient, and I agree with you. That's why, in the end, I will reveal a high-growth ETF that can potentially turn your $10,000 investment into a 7-figure portfolio valuation paying over $50,000 in annual dividends. Third on today's list is iShares U.S. Broker-Dealers and Securities Exchanges ETF with the ticker IAI. This ETF focuses on companies that run the show when it comes to trading, brokerage, and securities. It holds big names like Goldman Sachs, Charles Schwab, and the NASDAQ. These are the companies that thrive when the market's buzzing with activity. Here's why IAI is a strong choice for 2025. The financial landscape is evolving rapidly, with trading volumes on the rise, fintech experiencing significant growth, and retail investors becoming increasingly active. Events like the GameStop surge highlight the growing impact of everyday investors on the market. This ETF stands to benefit directly from the increase in trading activity. What makes this ETF stand out is its balanced mix of traditional leaders and innovative disruptors. On one side, there are established institutions like Morgan Stanley, with a long history of navigating various market conditions. On the other, there are fintech-driven platforms like Nasdaq, which are reshaping how trading operates. This combination offers a strong blend of stability and innovation. Featuring a 1.02% dividend yield, this ETF combines robust dividend growth of 11.87% with a strong share price appreciation of 13.81%. Starting with $10,000, this ETF turns your investment to $11,483 after 1 year. After 10 years, your investment grows to $39,569. Fast forward to 20 years, your investment of $10,000 would be worth $154,313. At the 30-year mark, the investment will reach a valuation of $594,652 with annual dividends of $3,004. The overall increase in your portfolio's value is $584,652, including $557,997 from capital gains and $26,655 from dividend reinvestments. Now, before showing you the final ETF that can add $1 million to your portfolio, the number 2 ETF on our list is Global X MSCI Argentina ETF with the ticker symbol ARGT. This ETF is like a golden ticket to one of the most exciting emerging markets in the world. If you're wondering why Argentina, well, the answer is simple. The country has incredible potential. Sure, it's had its fair share of economic challenges. Okay, maybe more than its fair share, but that's part of what makes it such a profitable opportunity. This ETF invests in big players of sectors like agriculture, energy, banking, and technology. Companies like Mercado Libre, the Amazon of Latin America, or YPF, the nation's leading energy company. ARGT offers a unique opportunity to invest in an emerging market that isn't widely explored. While markets like China and India are well known, Argentina presents a less crowded yet promising option. Of course, there are risks, but they come with the potential for higher returns over time. A dividend yield of 0.97% coupled with 15.24% dividend growth and 14.06% share price appreciation highlights this ETF's strong financial foundation. For someone starting with $10,000, this ETF grows to $11,503 in the first year. After 10 years, the portfolio reaches $40,749. Give it 10 more years, and in 20 years, it grows to $167,895. Fast forward to 30 years with reinvested dividends, the portfolio value climbs to $700,413, paying an annual dividend of about $8,271. Your portfolio's total value will grow by $690,413, with $633,145 coming from capital appreciation and $57,267 attributed to reinvested dividends. And finally, topping our list is ProShares Ultra Dow 30 ETF with the ticker symbol DDM. If you're someone who loves the idea of betting on big, stable companies but wish you could amplify your returns, this ETF can do that for you. DDM is designed to give you 2 times the daily performance of the Dow Jones Industrial Average. In plain English, if the Dow goes up 1%, this ETF goes up 2%. Why is this exciting for 2025? Well, the Dow is packed with some of the most established rock-solid companies on the planet. Think Apple, Microsoft, and Coca-Cola. These are the blue-chip stocks that are built to weather storms and come out stronger on the other side. DDM lets you double down on these heavyweights without having to overcomplicate your investment strategy. You might question, well, doesn't doubling down on returns mean doubling the risk? Kind of, but not really. While leverage does amplify daily movements, it's important to note that the Dow Jones isn't a speculative tech index. It's a collection of well-established companies with strong earnings and solid balance sheets. This means you're using leverage, but with a relatively stable foundation. This ETF has a 0.98% current dividend yield, backed by impressive fundamentals like a 21.43% increase in dividends and a 16.5% rise in share value. Starting with $10,000, this leveraged ETF turns your $10,000 to $11,748 after 1 year. At the 10-year mark, the portfolio hits $51,146. Fast forward to 20 years, your investment would be worth $278,963. Give it 10 more years, and in 30 years, the portfolio reaches a $1,686,802 valuation, paying $55,405 in annual dividends, which translates to $4,617 monthly. The overall increase in your portfolio's value is $1,676,802, including $1,405,174 from capital gains and $271,628 from dividend reinvestments. Want to know how to turn a $30 weekly investment into a portfolio that pays over $5,000 in monthly income? Click the video on the screen.